Okay, well, hello everybody. Today we have an exciting panel about volatility options and trading as an asset class with professionals in the field, Kambiz Kazemi, Timothy Jacobson, Vishal Olson. I will give them a chance to introduce themselves in more detail. And I am Dmitri, Alexeev, the moderator. So we have interesting topics to discuss. And why don't we start with the introduction with a mandatory disclaimer, basically first, that this is a professional event for professional investors. We do appreciate understanding that past performance is no guarantee of future results. And with everything else, again, keep your discretion and understand that this is, again, a professional discussion for people who want to learn and understand the field a little bit better. So with that having said, why don't we go and take turns introducing your companies and yourselves. So Kambiz, please go ahead.
Yes, hello to everybody. Thanks, Dimitri, for the invitation. Happy to be here. So I'm a principal at la Financiere Constance. We are a Canada-based firm. Essentially, we do run some proprietary strategies in-house, which are systematic on the VIX and S&P. We also provide some risk advisory services to medium-sized institutions, family offices. And finally, we also recently have been licensing some of our systematic strategies to BNP Paribas, which is a European bank. So as far as my personal background, started in the financial market back in 2003 in the derivatives world on the sell side. And then since 2007, I've been, managing capital in a relative value type of strategies, multi-asset, multi-geography, always with a focus on options.
Thank you. Vishal?
Yeah, hi. I'm basically the CEO, principal, and majority member of Holson Asset Management. We're a U.S. registered independent introducing broker that focuses on offering institutional grade CTAs and working with hedge funds, either as an in-house or third-party marketer. I've been in the industry since 2006. I started off running a trading desk for E-mini S&P, gold and crude oil options and futures. And then I transitioned 2 years later into managed futures. And I've been traveling the world and the globe looking for the best in breed managers ever since.
That's excellent. And Timothy, your turn.
Yes, hi. Glad to be on with Vishal and with Cam today. And Dmitri, thanks for the invite. So yeah, we're Pearl Capital Advisors. We're based here in San Francisco. And we run a flagship program, which is a relative value trade between implied and realized vol using VIX and S&P. And then we're also, we haven't formally announced it, but we're also rolling out 2 additional programs that are also within the volatility space that also deal with addressing different solutions, different ways of harvesting and utilizing volatility information in the market to provide different types of return streams. So really specializing in all that volatility has to offer. And this is looks to be a great panel today with good people that know what they're doing.
Oh, thank you. And thank you, everybody. So let me introduce myself as well. I am the CEO of AlphaBot. It is a professional network with integrated analytics. Or we can call it a professional, collaborative alternative investment research platform. So the word platform has been quite overused, I think, in the industry because almost everything is a platform these days for one thing or another. And it has many unique features, especially signifying the focus on making alternative research quick and efficient. So we eliminate the need of working with multiple spreadsheets, the analysis and quick and easy. And of course, one of the biggest features is the professional networking part, where you can connect to hedge fund managers, including some of the participants here on the panel today, get access to their performance track record, build portfolios on the fly, and basically send your results back to your clients and work in many other ways. So we will be using the system for the background information. And why don't we then start? And I will switch to our AlphaBot. And here we have a list of a few benchmarks that would represent slightly different approaches, like CTAs, different strategies, hedge funds, relative value, and obviously the equities. And we also have the bond index as well. So what we want to show is, okay, what exactly is relative value, how it works, and what is the role of options trading. So Kambiz, would you mind giving the intro into the strategy? You're on mute.
Yes,
Okay,
yes, absolutely. So I would say, the definition of relative value obviously is a general and wide one. Essentially what it resides is that you define or try to find relationships between different other securities, different assets, or sometimes within the same assets. So it's all about finding relationships that you think that are robust, and more than often they will be holding through time, and then trying to build up strategies around them. Now, I guess the one thing that's quite nice in the volatility space, Tim was mentioning that they're involved a lot in the VIX and S&P, is that the relationship between volatility and the underlying security oftentimes is a negative correlation, i.e. market goes up and volatility goes down, and vice versa, which is robust, more so than if you look at relative value, say, between stocks. Apple and Microsoft over time can change, but this type of volatility relationship with the underlying is robust, and that's why it makes for interesting opportunities. So really, that's the world, I guess, the application of it in the option world. And what we do is essentially we try to find this type of relationship, whether it's among the VIX itself, different components of VIX, VIX S&P, and so on, and then build strategies that are risk control and robust around it. And I'm sure we're going to talk about short vols and all these things that involve. But in a nutshell, that's at least how I define relative value.
Okay, and how does the option trading come into this game?
So I would say there's really two aspects to it. First of all, option trading, it comes into it because you would be trading, the options based on the relationship you find. So for example, the price of the option itself is driven by volatility. So you can trade the underlying versus the option. That would be one relationship, one relative value. But the other thing is when you build relative value strategies, even for people who are not in the volatility space, let's say they can do long, short equity and so on. You can use options in managing or designing those strategies. And, maybe later I can give a simple example that is not necessarily a volatility relative value, but if you're looking at what's happening lately on the, S&P, where it's driven by a bunch of names, you can have ideas about building relative value trades whereby you're long the S&P and short, for example, the banks, but use the option to make that strategy risk control. So that would be one sort of relative value. So it can be used both as what is to risk controlling the relative value or actually being the one leg of the relative, if you will.
Very interesting. So what kinds of benefits the relative value strategy provides? Because obviously there's specialization of sorts in hedge fund industry. There are macro managers and CTAs and other kinds. So what is specific for the relative value? Tim, would you tell us how is it beneficial and in what aspects is it different from other types of strategies?
Yeah. So if you have, I don't know if you can build this sort of portfolio on the fly as we're talking about it, but I think if we start with sort of the standard investment portfolio of institutions and even family offices, they have some sort of flavor of the 60-40 portfolio, some flavor of 60% of equity exposure, and they can do that through venture, private equity, and also in the public market. And then they may have about 40% of their portfolio in bonds or private credit, things of that nature. So if you were to have that basic 60-40 portfolio and then think about how you might begin to diversify around that, our industry within the managed future space has historically said CTAs really ought to be the featuring or the featured diversifying strategy. But if you look back over time and you consider relative value volatility as the primary diversifying strategy against the 60-40, I think many industry practitioners would be surprised to see that even when you include 2008, that relative value volatility has done a remarkable job at providing stability to the 60-40 portfolio, both in terms of retaining the return profile of the 60-40 as well as the risk reduction. The CTA index, if we use the Barclay Hedge CTA index, I think we would find that while there is a reduction in risk to the 60-40 when we start including the Barclay Hedge CTA index, there's a dramatic drop-off in returns, even when you include the 08. So I think institutions really should take a step back and consider that CTAs are really more of a trend-based philosophy and really geared towards capturing macro inflationary and deflationary trends. And those trends don't necessarily move in lockstep with equity volatility, whereas relative value volatility in the equity space, by definition, does fluctuate with the volatility of equity markets. Oh. And so it would make sense, therefore, that it would be a natural addition to a 60-40 portfolio in that it can provide some downside protection. And quite on a consistent basis, actually, it has shown that historically, the asset class has. And so institutions really would do well to kind of take a step back and consider what really should be my first core diversifying strategy. Should it be CTAs or should it be something more like a relative value vol?
And as you were speaking, I took it as a personal challenge if I could build that portfolio on the fly. So I didn't get the all exact weights, but we can obviously play with that a little bit and change it. So we do have the, I think the bonds are missing still, but we can add that as well. And again, without even playing with the weights, keeping it simple and equal weighted, you can definitely see that the aggregate behaves much more impressively than the components, right? So that is the key point of diversification, and that is the key point of the benefits, because two of the components here have extraordinary drawdowns, the equities as well, as we may know, but the combined portfolio regardless has excellent characteristics. And of course, the disclaimer doesn't have to be repeated all the time. This is a quick historical pro forma, so everybody understands that, but still it has a lot of value in analyzing what kind of impact mixing different kinds of asset classes has on your exposures and your type of return, so to speak, or return profile. So this is a very, very impressive addition, and the stability benefits seem to be quite impressive as well. So how do, let me see, how do managers approach to taking advantage? Because obviously there are two sides, right? There are managers who actually are trading in the space and producing those return profiles. And then there are investors who consider including those managers in their portfolios. So let's start with managers first and see how they see the space. So what are the managers doing to take advantage of this? And what are also the cautionary tales? What are you to look for to avoid the risks that are often associated with option trading? So who wants to? Vishal, can you comment on that?
Sure. So I think one of the most important things, especially when evaluating and performing due diligence on managers to trade options or volatility, it's very imperative that the investor or the institution, whether it's a high net worth individual or some family office or an institutional investor endowment, that they, you know, and most of the more sophisticated investors will know this, but you should definitely get a hold of daily returns because you want to know the intra-month volatility of the program. And I think a lot of institutional investors have gone into short vol without actually performing an exhaustive due diligence on the manager, which includes taking a look at intra-month volatility. With a lot of short volatility strategies, we will see the month-to-month volatility may relatively be low single digits, but intra-month, you can have, you know, volatility of upwards of, you know, 5 to 10% on occasion. And I think in the past, before these blowups we've had in 2018 and 2020, if these allocators had asked for daily returns, they would have been surprised at the amount of intra-month volatility that they did not know that they were taking on. I also think that it's a mistake for any allocator, whether it's a high net worth client or an institutional investor, family office, endowment, should ever allocate to a short vol, short gamma strategy without combining it with a long vol or vol arb type of strategy, whether it's a strategy like Tim offers, and there's probably 2 other institutional grade CTAs that offer volatility strategies. So I think when you're doing your due diligence on short vol, you want to take a look at the manager's pedigree. You want to take a look at the intra-month and the daily returns. You also want to take a look at the manager's risk management. We all know and have seen over the last 10 to 15 years in various cycles, when the markets are favorable for short volatility, you know, volatility is relatively in a controlled range and the market's kind of moving up slowly with occasional pullbacks. All short vol managers are going to look good. The hard part is not making the money when the market environment is optimal. The difficult part of being a short vol manager and why so many short vol managers fail, and this would be 90% plus, is because their risk management is not fully systematic or mostly systematic, and they're making a discretionary decision on how to mitigate and manage risk. So whenever I look at a short vol manager, if their risk management or risk mitigation is highly discretionary or even 50% discretionary, I won't use them. I think that leaves room for error. I want to know exactly what a short volatility manager who sells options is going to do when they encounter a bearish downturn in the market, and I want that to be predictable. So those are just a few of my suggestions.
And as I've been speaking, I pulled the VIX versus S&P in daily mode, and we can see this. This is where the famous adagio, I think, of picking pennies in front of steamroller comes to play. And the risk comes from my experience in the industry is that the risk comes not exactly from picking pennies, but from the fact that the steamroller can suddenly become a supercar and charge 10 times faster. And that's where the risk is coming from. And people don't realize that. They think it's basically safe because it's slow moving. But as this year indicates, you can see it dwarfs like the drawdown, which is by itself considerable, 30%, but the spike in volatility is enormous that was associated with the sell-off. So you can get easily caught off guard. And by the way, a simple illustration to your point of daily data, if we look at this on monthly basis, look how much more tame the picture becomes. It's like it scaled it up. So there's half of the volatility suddenly there, because it intra-month and it happened and it went. So if you only look month to month, then you are not going to see the actual dynamics of what happens. And of course, for those who are actually trading the markets, the intraday dynamics obviously becomes also quite important. So anybody else, how is your approach to managing the strategy is working? How is it different? Anybody wants to share? Timothy?
Yeah, I wanted to piggyback onto what Vishal was saying, that I think it's really important for institutions and others listening that there's different styles of volatility trading. And when we think about volatility trading, we typically put them into two camps. We typically put them into the premium sellers, which is not what relative value volatility trading is, right? That is, relative value volatility trading is trying to capture the difference between the implied volatility, which is the volatility that the options market is telegraphing, and the actual volatility that the market is generating. And so if you're an options seller, you're just looking for moments when it behooves you to sell and collect premium. And that's the steamroller analogy that you're talking about, Dmitri. But relative value volatility actually has the ability to capture the convexity that you're seeing there on the chart in the VIX index. It has the ability to get exposed to that long volatility move and capture that on a relative value basis. And the other camp of what people talk about is tail risk, which is effectively always trying to maintain some sort of long volatility exposure, which also has its weakness in that in order to maintain and hold that cost of carry or that long vol position, there's what you call bleed out, which is the decay of the option premium as you're trying to hold that long vol position. So the short sellers as well as the long buyers have problems in that the short sellers are exposed to the sudden changes within the volatility market, and the long buyers are subject to the bleed when there's not volatility. Whereas relative value volatility is one of the or one of the trading approaches that can or has the potential to mitigate both of those risks, in that it has the ability to capture the convexity of volatility, but also is not subject, but also mitigates the bleed, if you will, by harvesting the differential between the implied and realized vol. I don't know if Cam sees it differently or the same way, but that's the way we would.
Yeah, no, mostly, yeah. I mean, I think it was by Tim and Vishal. I would say, like, what this thing, I fully agree with Tim. We don't run anything short gamma, short volatility systematically. It's just, I've you know, I know there are people who do that. I know also there's lots of, you know, bad stories and bad endings, including in March. You know, I always say to friends, you know, like it requires a specific type of, you know, approach to be able to go to bed at night short gamma, right? So I don't have that, so I don't dabble in that world. And we stick to what you were saying, which is essentially, if we have positions that are short, well, let's want to be convex on the tails anyway. So that's obviously the challenge with that is option world. People call that a little bit the holy grail, right? Like trying to have carry while being long convexity. I don't think anybody has the magic formula, and it requires a lot of adjustments and so on, but that's kind of what we strive for. You know, it's really at the end of the day, the goal is to be more often right than you're wrong. And when you're wrong, avoid major drawdowns, which can be very, you know, acute in the case of leveraged products like options or volatility, which itself is extremely volatile. But in general, yeah, that's why relative value is really what makes sense. And, you know, I think there's other indices that you had mentioned. I mean, the CBOE has also a short vol index, the tail hedge index. So when you look at those, you know, the tail hedge index obviously bleeds away all the time, and then the short vol index, you can see that it has, you know, major drawdowns and obviously stress periods. So the idea would be, you know, to put it simply, if you could combine those two in a systematic way to achieve relative value, that's kind of what we aspire to, right? So.
Yeah, and this is just a quick adjustment I made to normalize the volatility so that we put them on about the same, excuse me, volatility footing. And that's exactly the illustration of your point. So the tail risk strategies, they tend to bleed when there's not much volatility going on, right? And then when something happens, that's where they actually take advantage of that and start actually generating returns. So that is very interesting. But do you notice that the volatility, not the volatility itself, volatility is there and it will be there, but the nature of volatility, the historical aspects of where the volatility is coming from. How do you see that? Is it changing? Is it still pretty much the same? Tim, any comments on how do you see the volatility regimes changing or evolving over time? And let me see if I can pull a larger time.
Yeah, if you can pull a larger time frame of the VIX index, we can see it actually quite clearly how volatility tends to move in regimes. There's the theory, of course, that volatility clusters, which you actually can observe. And what that means is, if you want to know what volatility is going to be today, just look at what volatility was yesterday, and it will be the same plus or minus an error term.
Mm-hmm.
Right, so statistically speaking, that's effectively the way that volatility behaves. Is it will cluster within an area or within a range until it then transitions to a new range. And what we find is that we can bifurcate the volatility regimes into two different environments. You have the low vol regimes, and then you have the higher volatility regimes. In the lower volatility regimes, and these are multi-year regimes, but keep in mind. So yes, this is perfect. So in the early 90s, we troughed in a low volatility regime until we got to the late 90s, and then volatility clustered between the 20 and 40 range, whereas prior it was clustering around the 15. And then when we got into 04 to 07, again, we dipped back down to a low volatility regime where volatility clustered around 15. And then in 08 to 2012, we clustered around a higher mean. And again, primarily staying, with the exception of the 08, primarily staying within that 20 to 40 range, which then was followed again by another multi-year low volatility regime. And we believe that we have, as of February, fully transitioned now into a higher volatility regime, which we are expecting. Now, we don't include this in our trading. It's all of our trading is systematic. We take what the market gives us. But just as a psychological guidepost, we're anticipating that volatility will stay elevated for the next several years, probably 2 to 5 years, much as it has in the past as we go into these cycles.
And what would be the primary contributors to that prolonged volatility elevation?
Yeah, great question. That's always a difficult one to know because it can come from rapidly rising markets like it did in the late 90s, but it can also come from bear markets and sideways choppy markets, as it has in other periods. So, what's going to actually cause it to stay elevated for the next 2 to 5 years is anybody's guess. We're just making the observation that it's very likely, given the move that we saw in February and March, that is likely signaling that we are now in a high volatility regime that's likely to stay there for whatever reasons cause it.
One theory that I recently was trying to kind of formalize and observe and see if I can find any justification for it is that the cycles are shortening, and yet at the same time there seems to be a lot of talk about cash on the sidelines. So what basically it means that there is a lot of unallocated strategically liquidity, right? And people start panicking when they see something happening in all markets, like from gold to real estate, looking with what happens even in politics, even though we don't want to go into politics. People are selling real estate in one area and buying everything they can in another area, trying to move from a city to suburbs or vice versa. or state to state. And then the same across the markets, right? People flooded into equities and dropped hedge funds, then did the opposite, and so on and so forth. And it seems to be that those moves are kind of becoming more dramatic over time. But that's at least one of my attempts to understand what may be contributing to this movement. So this is great. Kambiz, can you tell us, so then how can now from the point of investor, can they take advantage of relative value and the benefits that it offers?
I mean, maybe I'll just also talk in 1 second about the last question, if I may.
Okay.
That was I mean, Tim mentioned obviously the characteristics of the volatility, the clustering, and so on. The one thing that we try to kind of get our head around and pay quite a bit of attention to is that the effect of the change in the instruments and the participants in the market. Because if you will, when the VIX index, for example, goes back to 1992, the old methodology used and still uses the new methodology also, the S&P options. All the way to early 2000, the only way to really trade volatility was using options, right? Like listed or OTC options. And then 2001, 2002, there was these new instruments that trade over the counter. They call them OTC. So, VAR swaps, which use options, but they're a different type of instrument. And then 2005, you had the VIX futures being listed. So the volatility world is a very, I'd say, interesting world, because compared to the stock world or the bond world, where in the last probably, 100 years, there's no novelty it mentions or is the same instrument. In the volatility world, the measure was there, but to trade it, there's a lot of new instruments that come along. ETPs and ETFs. VXX started in 2009. Then you had the famous XIV, which is short. So these things, and the reason I'm mentioning this is that blur a little bit the picture for those of us who are looking at these vol regimes, right? Because a lot of time you go back and you want to, look at historically, okay, this kind of stress event happened, you go in a higher vol regime. These instruments, however, sometimes they can become so big in a market that otherwise, is constrained in its size compared to like an equity market. Think of as if, for example, one stock became literally, 30-40% of the whole equity market, that kind of situation. So if these products get big, or the way people use these products become very similar, then they can affect things. And as you remember, the 2018 scenario in VIX, the famous VIX gate was one example of it. Everybody had to buy this thing and it went up. But more recently, the last 10 days, actually, we were just talking with him before we started the conversation, and yourself, is, we're seeing this kind of a break in the relationship of the markets going up over the last, before today, over the last 10, 12 days, almost 5%. And the 1 month constant VIX was up almost 30%. So again, this is testimony of, how people use differently options, and in a regime where the market goes up, if people use options to place those bets, you can, change that relationship, and suddenly the signals that you get and the way that you see the regime might be affected by it. So I just want to talk about that. Coming back to your point on the relative value, I mean, it's, I think I would say one thing about relative value. If you're an investor, when you get into a relative value, more than often, the goal is that it's not kind of like, something that you're going to try to time and trade around. Simply put, a good relative value is a buy and hold, because you are essentially, over time trying to find opportunities and managing risk. So there's no reason of intervention of the investor to get in and get out. So that's one major element. The second thing I would say about relative value, you gotta figure out as an investor, where does it fit in your portfolio? How does it complement your portfolio? Now, most relative values are designed to be, absolute return, right? But that's not in itself sufficient, because you could say, yeah, I'm just going to own it because over the long run, it's going to supposed to be above zero all the time. Notwithstanding that, it will have some correlation with other things. I think what specifies and what's neat and interesting about, option volatility, relative value strategies, and if you go back to the CBOE, index, is that they're generally not correlated much with other stuff. So, that makes it suitable for a lot of type of portfolios. They're not too correlated with equities, because as you saw, when things go down, they'll hold normally because you're relative value, or even make money potentially. They're not overly correlated with fixed income, simply because fixed income has gone one way, over the last long while. And so it makes it an interesting strategy in general that is maybe underlooked, I would say, having dabbled in it for 20 years and gone to many conferences. But on the other hand, should it take off and be very successful, and we're not there, and hopefully we get there, that's a good problem to have for managers like us, is that it's also a world that could, at some point, if all big institutions get into it, have its limitations in capacity. So that would be my high level about, what's its use, where it fits, and so on.
Great, and I totally agree from my years of portfolio construction. And that's, by the way, why I built AlphaBot, to make that task easy, because I got tired of copying data from spreadsheet to spreadsheet. I wanted time to think about actual portfolio construction, not typos I make copying returns from spreadsheets. So you can definitely get different results if you are starting with a different point, because we had this simple mock-up, right? But if you are already in different asset classes with different exposures, you can fine and tune your proper amount of the relative value strategies quite easily as well. And you can see what it does and how it works for you. So basically, the result will be different depending on where you are and what your portfolio looks like, of course. So it's not necessarily standard answer, allocate 10% to alternatives, right? If you want to get better results, you need to have slightly more sophisticated strategy, I think. Well, Vishal, can you tell us also what is there to watch for from investor viewpoint? Because obviously every manager in the space try to do their best, but not all of them, of course, achieve great results. So, and probably there are some also red flags or something to watch for when investors perform due diligence. How do they approach selecting relative value managers? You're on mute. I'm sorry. Can you unmute?
Sorry about that.
Oh,
so, one of the things that I think investors want to do when they're constructing a portfolio, especially if it's going to be a relative value portfolio and they're coming into the managed future space, they want to take a look at what they already have. And generally, as we've talked about, the 60-40 traditional portfolio, 60% equities, 40% bonds. Obviously, a lot of institutions have scaled back their bond exposure. But if they're coming to allocate to CTAs, managed futures, I think what they don't want to do is allocate to a strategy that has a high correlation with what they're already doing. So they want to come in and they want to build a portfolio of managers. And it doesn't have to be 10 managers or 20 managers, but you can find 3 to 5 very good institutional grade CTAs, and you could build sort of a balanced volatility, relative value, global macro type of strategy that would outperform any of these single managers on a standalone basis. So I think diversification is key. And then you want to combine different types of managers with each other that are not correlated highly.
But Vishal, we didn't plan this, but you're making a point that I think is being lost right now on a lot of minds in the industry. I think there's been 2 or 3 major Wall Street banks within the last several months that have said, okay, interest rates are now 0, so we need to figure out a replacement for bonds in institutional portfolios. How about real estate? And I looked at that article and I thought that is that is crazy. Okay, I get that institutions need income, that they need to have some way to generate income, whereas the coupons of bonds were able to do that before. Maybe they're not able to do that now. But I would not think that bonds are in people's portfolios for income primarily.
Mm-hmm.
I would think that they're in people's portfolios primarily for risk reduction and for diversification, because long-term government bonds are a great diversifier for equities. I think relative value volatility actually should be the asset class that's taking the place of bonds, of bond exposure in institutional portfolios, because it is the one asset class that has consistent negative correlation to equities, and because there is a relative value opportunity that that basically delivers that diversification component. I would not think it's the coupon or consistent income generating that is the most important part of the reason why people have bonds in their portfolio.
And here's an example going back to Vishal's point. So kind of quick and dirty, again, with all the disclaimers, I think I can stop repeating that because we are professionals here. We understand the value of pro forma in understanding and modeling and its limitations. So here's like a quick sample portfolio of a few managers that you kind of like to put together, right? So any comments?
Absolutely. So we've got a short vol component in Buckingham. We've got a global macro component in Breakout. Obviously, we all know that short volatility strategies tend to use up a lot of margin. Generally, they're using anywhere from 30 to 60% margin to equity. So they're kind of margin hogs. When you're going to build a portfolio of managers and you have one manager who's using an extraordinary amount of margin, you generally want to find other managers who are not using an extraordinary amount of margin. And the nice thing about Breakout is their average margin to equity is about 4 to 8%, which is low. Deep Field Capital, their average margin to equity is 4.27. Disclaimer, you could easily substitute Tim's strategy, Pearl's flagship strategy, instead of Deep Field, but because we're all on the call, I wanted to use different managers. And what you'll see here is that, Buckingham had a drawdown peak to value of about 13.46% in February and March. That would have been heavily dampened by the addition of a vol arb or relative vol or long vol strategy, and the addition of a short-term long short futures trader like Breakout. And they're not a traditional global macro strategy. They're not trading 100 to 200 different markets, but they're trading 5 different sectors, over 30 different markets. And the nice thing about their performance this year is much of their return attribution, or a good part, is from actually catching the down move in the S&P in February and March, post February 24th. So you're going to get a lot more value from allocating to a vetted group of several managers who sort of match each other's or offset each other's weaknesses than you would by just trying to pick a single standalone strategy and going for it. And what a lot of institutions and investors do, they come over to the managed future space and they allocate. Everybody understands what the S&P 500 is. So for someone who's not a commodities or futures expert to come over to commodities and futures, they're going to gravitate towards the strategy where at least they understand what's being traded. So we've had a lot of institutional and high net worth investors come over to managed futures, and their first investment is a standalone short vol manager. And that's generally a big mistake because they're allocating to another long vol manager. For example, Buckingham Global's correlation to the S&P 500 TR is about 0.6. Historically, it's been anywhere from 0.3 to 0.7. It's on the higher end because of the 13% drawdown this year. But if you put together a group of managers like this, the correlation is going to be much lower. Dmitri, can you pull up the correlation for this portfolio versus the S&P?
Of course, I can just add S&P without any allocation real quick so that you can see it. And let me see. So, and to your point also, while I'm doing that, my comment historically as well, I totally agree because many investors need a little bit more education about alternative space, because quite often their own analysts, when they come from long-only space, they don't even have the same vocabulary. They ask you about what your beta is, like for a hedge fund manager, and the beta to what? It's like, so they only have one particular view, and sometimes it is much more important to understand what's going on. So I added it here so we can see correlations, and as you can see, yeah, the correlations are quite impressive, quite a wide range there.
Yeah, and then, you know, we're only getting a very low correlation to the overall S&P 500, correct, with this portfolio.
Yeah.
You can see the managers, you know, they range. You're going to have breakouts going to have a little bit of a higher correlation this year because they caught a good part of that down move in the S&P 500. Deep field, you know, as well as Tim's strategy, has had a few good months where they were able to capture significant down months in the market. I think, again, this is what I've seen. When you come and you allocate to a standalone short vol strategy and you have either the 60-40 portfolio or you have 60% in equities and 30% in real estate and 10% in bonds, if you allocate to a standalone short vol manager or some sort of long S&P strategy, you're just adding risk. You're not diversifying. And to truly get a diversification, you've got to utilize some sort of vol arb or relative vol strategy, balanced vol strategy, and you've got to get some pure commodities exposure, whether it's gold, whether it's silver, and you're just buying an ETF, or you're using a manager that actually can access those markets using futures or options.
So it's not as simple as putting a checkbox to the question, yeah, I got a relative value manager, and that's it, I'm done, right?
Absolutely. A lot of due diligence to be done, a lot of, as you know, portfolio construction to be done, you know, tinkering around with the portfolios. You could easily, the portfolio I constructed, you could easily make it an equal allocation. I didn't do that because I actually think if you have a portfolio of 3 to 5 different CTAs and your short vol manager, generally, if they're not getting an equal allocation, they should get a smaller allocation because that's the manager with the most risk. We can say whatever we want, you know, short vol manager one, their largest drawdown is, you know, under 2% for 5 years. Well, out of left field, they can have a 15, 20, 25% drawdown. And as we all know, short vol managers theoretically, you know, in a fund, they can lose all the money potentially. And there have been some large short vol managers over the last couple of years that have unfortunately gone belly up. And one of the reasons that they did not survive was because it was capacity issues. With short volatility strategies, I've never seen a short volatility strategy in 15 years with over $300 to $400 million of assets under management who survived much longer after reaching 500 mil under management. You know, we had a $1 billion short vol manager blow up in 2018. When you try to exit the market and you have $1 billion worth of short volatility or short options and you're trying to get out of them all at once, the market's going to see you. So I think with short vol managers, in addition to the intra-month volatility, daily returns, which are paramount. If you don't have that information, you shouldn't allocate. You also need to look at the manager, their correlations to your current strategy, correlations to other institutional grade CTAs that you want to implement. And they don't have to be the largest portion of your managed futures portfolio, but if done correctly, they can be a valuable source of consistent revenue in optimal market times.
Mm-hmm. And here I just pulled a peer group of quite a few managers in the space. Again, not to name anybody specifically, but you can see that there is a lot of variety, of course, to choose from, and then the approach can become quite sophisticated, as you mentioned. And we can see that there's multiple aspects to portfolio construction process, even when involving like a pick of 2 or 3 relative value managers. So again, it's much more complicated than a simple checkbox. The strategy has its benefits, but it also needs to be taken care, approached with certain respect, right? It's a power tool in some sense, and you can get, like, you can build a house with a chainsaw, or you can cut your limbs off, as I sometimes say. Be careful with what exactly you're trying to do and what your skills are. So that is great. Well, specifically then, to kind of wrap it up, any more tips for the investors as far as what are the biggest risks? I think we've mentioned already some of this. You did mention funds blowing up. We did mention the due diligence questions. So from everybody's, like, in your opinion, again, what are the most difficult aspects of this strategy and how you mitigate that? Anybody? So Tim, we can start with you.
Yeah, it's for relative value volatility, it's important to be able to get the value correct. That's the first question, is what is the relative value between the implied and what is the difference and the realized. Also, I'd say that there are managers within that space and within that universe that you just pulled up that are doing other things outside of relative value and incorporating that into their strategy. They might be doing other types of trading. They might be taking directional exposure. At Pearl, we've always tried to be a pure play to that relative value vol. We are coming out, as I alluded to earlier, with other strategies, and we will be offering those all on a combined basis. But we want to keep separate the different types of exposures and the different types of things that you can do within the volatility space, so that people can pick and choose the solution that's going to work for them. But when it comes to relative value trading, you've got to get that valuation right, and then you've got to be able to understand how to set that hedge ratio correctly as well. When it comes to the other types of trading that you can do within volatility, it's important to be able to understand the inflection points within markets, and have a very good handle on the data that would indicate to you when those inflection points are occurring, so that you can then make the appropriate adjustments, so that you can keep that convex exposure when you need to have that convex exposure.
Thank you. Kambiz, any comments as well on the risk and their mitigation? You're on mute.
Yeah. So I would say, I think the aspects about risk have been very well covered by Vishal and Tim, which are, obviously, if you have any sort of returns that have as a source short volatility, then that's your risk, and how that's addressed, whether it is by some of the managers that Vishal was mentioning that might have some pedigree or systematic methodologies, or to some extent discretionary, or by balancing out with a convex book. So that's the kind of question probably you want to ask and focus on. One thing that is not directly related and answer to this, but it's kind of we've seen recently, is that our strategy kind of has the component where we kind of try to generate some income, and then we have some convexity hedges. And what happened is a lot of people ask questions of how this is built up. And it took us a very interesting place, is that actually we are having people who want pieces and bits of it. So some people are saying, we want that convexity part of it only. Or some other people say, we want this part of it only, or we want this under strategy. And so that's where we've gone the road of actually creating, investable indices, for example, with the banks that already do this, but they don't do it with the buy side like us. So we kind of took that route. Or we also have provided the methodology to under licensing to some institutions, because they like to have the specific streams. If you think of it, a fund or investment vehicle is a commingled vehicle, right? Where the manager is doing a bunch of things together. But to the extent that that the discretionary on that is almost nil, then it can be decomposed and somebody could just make their own thing off the shelf. A little bit more of the convex, a little bit of less of this. So that's, we're not there yet as an industry, but it's something to keep an eye on. And the reason I think it relates to your question is that in itself could be a way of risk management, but also adjusting your portfolio. Like Vishal showed us how you can do diversification by different funds. The next stage that might be, 5 years out, 10 years out, is probably for intermediaries that are experts, or in some of the expert investors themselves, to actually diversify based on return streams and not necessarily off the shelf funds. So that's one way of risk management. Is not there, but it feels that it wants to come out. That's what we see. So
there's definitely interest in, you can call them risk premium, you can call them factor-based investment, where people, obviously you need to be a little bit more sophisticated, but to understand how to work with such things and what they are. But they want, yes, exactly as you said, a particular component of your strategy, so that it complements them the most without much else. So I see interest like that. We do have strategies like this on our platform as well. And it's interesting to see how they operate and how they work. Interesting. So I think we have just a few minutes left, and we do have participants who may have any questions. There's a Q&A button in Zoom, so you can ask a question. Let me see. If we don't get any questions, then while we wait for any questions, any last comments, any conclusions? What would you say to the audience and potential audience who will view this as a podcast?
Well, I mean, I have a question for Tim. A lot of institutions now are looking to hedge their equities books. Usually they'll have some sort of in-house hedging department or team, or they'll look for outside managers now, relative vol, long vol arb strategies to hedge their book. If a particular institution came up to you and said, look, we have $300 million, $400 million in equities spread across 10 different hedge funds. It's got a correlation of 0.7 to the S&P 500. How would we go about hedging our book using your strategy, or reducing the potential volatility of being, having a long S&P book using your strategy?
Yeah, so that's a great question. So my short answer would be that, we actually offer custom solutions for that. Mm-hmm. So we don't necessarily say our commingled fund is a solution to your problem. Mm-hmm. The kind of conversation that we have is, we do have strategies that are systematic that also go as a long convexity and hedge in our commingle, but that would address that specific problem. So some of them are based on the VIX complex, and they're signal based, and some of them are based on S&P. And they're not. So the one thing I would say is that all these strategies that are time systematic, like, do a put and roll and so on, that is not a solution to this problem. So that's the short version of it. There is a lot of them out there, and I love CBOE, and with all due respect to CBOE, there is all these passive indices that we roll, but we do have, so it's a subcomponent of our commingled strategy, where we can show people, okay, this is how it's going to look, or would have looked on your portfolio if you had it. And then we have a couple of solutions that we would show them, and if they care about that, would be option 1 and option 2 to go with. So, and that's what I was saying, customized things and specific revenue streams probably makes sense, because if you already have a bunch of funds, do you really need another fund to address that problem, or
that's
do you need
question.
Yeah.
Mm-hmm. Now, Tim, what about Pearl? Same question, same institution. I can create a customized hedging portfolio, using puts, and make it pretty systematic. But instead of me doing that, or my firm doing that, we had a client who has, $300 or $400 or $1 billion book. of long equities, and they are looking for one manager to work with to partially hedge, not fully hedge their book. What would you recommend, and why would you recommend your particular strategy? What particular aspects of your strategy would lend itself to having that kind of client?
Yeah, give me a call after this, Vishal. Let's talk.
Yeah.
Yeah, that's right. I mean, there's absolutely the convexity component that can be captured, and it can be captured in a variety of different ways. Currently, in our flagship, we capture it through a relative value approach, right? And so it just comes down to a question of the right mix for them to achieve the proper diversification that they're looking for, such that they can get to the amount of risk reduction that they want. But also within our newer strategies, there are more specific ways that we could actually address providing an overlay potentially over the full book. So there's lots of ways to address the question, and that's really what Pearl does, is we view ourselves as specialists in the volatility space, and being able to offer a variety of different solutions depending on what your objectives are. And so if we would always say that our flagship is really meant to be a portfolio team player, in that it can reduce, and I think there were some charts in there earlier about risk contribution. Yeah, we can provide some meaningful risk reduction through just adding our program to a portfolio. But also, and of course, past performance is no guarantee of future results. But then if you're looking for more of an actual hedge to mitigate equity volatility, well, we have other solutions for that as well. So we're trying to run the gamut of meeting people's objectives depending on where they're at.
Understood.
If I, Vishal, the one thing I would want to add, and you probably know this already, the thing is with, the overlay things are happening, but I think the edge is vol managers probably, can translate that expertise in making overlays that over the long run are way more attractive.
Yes.
The least drag for the better buck. The number two is, I can tell you that, so when you take a fund, you're going to pay whatever it is, 1 in 20 or 2 in 20 or whatever. But the overlays, I think our perspective is that people who really have that problem of equity exposure, overlays economically are way cheaper. I mean, there's no performance fees, frankly, the economics of it. And it is really a design because it's already a negative drag. So that's how we have approached it. From an economic perspective, we're not offering it as a fund. We're offering it as a, basically just fee-based service. So it's reflected there. So you might not get as much of a bang for a buck and address your correlation problem with the off-the-shelf that you would with a really specialized overlay that might cost you only 35 bips.
Sure.
So, yeah.
So there are multiple ways to approach it, as we see. Well, I think we are pretty much on time, and we went through the agenda quite well. Let me thank everybody, the participants, the panelists. So thank you very much, gentlemen. It was a pleasure to have you here. As I mentioned, the recording will be created and posted on our blog, and you will get a link, and please feel free to disseminate it in your network. And I thank you again. It was a wonderful day to have you here.
Thanks for the invite, Dmitri. And
Thank you.
always good to be on a panel with these two gentlemen. And I look forward to connecting with everyone shortly.
Excellent.
Yes, likewise. Thanks, Dmitri. Thanks, Vishal. Thanks, Kambiz. Thanks, everyone.
Thanks for the invite, Dmitri. Guys, it was great spending time and chatting with you, and look forward to next ones.
Okay, well, excellent. Thank you very much. I will then close the meeting now, and have a great day and the weekend. Thank you so much.
Thank you.
Bye-bye.
Bye.
Bye.
Bye-bye.